Good evening, everyone, and welcome to today's exciting session on the topic The Secret Sauce of Quant PMS. We are thrilled to have you with us as we explore what truly drives consistent long term success in portfolio management. I am Aravind Ravindran from PMS Bazaar. In this session, we will uncover how smart asset allocation and real diversification can shape stronger portfolio outcomes, learn how using low correlated assets help reduce risk and stabilize returns, explore how managing volatility boosts long-term growth, and most importantly, discover why disciplined data-driven investing consistently outperforms emotional-led decisions. To dive deep into this, we are privileged to have our esteemed speaker, Mr. Vivek Sharma, Investment Head and Vice President at Estee Advisors. With over 10 years of experience in trading international markets at Futures First, he played a pivotal role in setting up their energy trading desk. Throughout his tenure, he trained hundreds of successful traders, contributing significantly to their growth and success of the team. Mr. Vivek holds a BTech and MTech degree in electrical engineering from the Indian Institute of Technology, Kharagpur. Welcome, sir.
Thank you, Arvind. Thank you for having me and really excited to talk to you.
Yeah. So before talking about markets and economy and your offerings, we would like to know about you, sir, personally and professionally. So if you can tell us about how you landed in quantitative investing space, it would be great, sir.
So, Arvind, I'm an engineer by education, as you have already told our visitors here that I did my engineering from IIT Kharagpur, but even during those engineering days, I was always interested in markets. It always seemed like a puzzle to me how the stocks would move up and down. So during the college days also, I remember I had opened a virtual portfolio on moneycontrol.com and I used to track few stocks and was really excited about what is happening to those stocks and why the stocks are moving up and down. So after my engineering, I did a job in tech sector for about a year, but markets pulled me, and that's when I joined Futures First. I was really lucky I got that opportunity, and I was there for 10 years. And fortunately, from the beginning only, I was able to do well. And during that time, I trained hundreds and hundreds of traders in international markets. So that was really a very, very exciting phase, lot of learnings, and a lot of also when I moved after my 10 years from trading to actually investing, lot of things I had to unlearn also because there are many, many things that work pretty well in trading, but they're very counterproductive in investing. So I had to unlearn and learn new things when I moved to Indian markets and also from discretionary trading to quantitative investing. Because at that time, this was around about 10 years back. And I realized that everything was going digital. Every business, no matter which business you are in, it was going digital. So that's when I thought that I should also move from discretionary style to a systematic automated style. And that's when I switched gears and moved to Indian markets and also in quant investing. So last 10 years I've been into quant investing and it has been a wonderful journey so far.
Yeah, it's great to know, sir. Impressive. So, speaking about the markets, how do global macro trends and domestic policies shape India's economic resilience and outlook, sir? And what do your quant model signal about these emerging risks?
So, Arvind, what happens in quant investing is we put everything into data, right? Yeah. Every single thing, whether it is macroeconomic data or microeconomic data, data related to stocks, a specific sector, or the economy. Every specific data point is captured and then used in our decision making and that's how we construct portfolios. So it's a very common myth that normally quant investing just looks at technicals and it ignores fundamentals, right? But at the end of the day, it is not really true. We do look at the fundamentals because every fundamental data, you name it, and it can be actually captured in a data format, and that's how it can be used in these quantitative strategies. So we are using in Estee. What we try to do is we try to have a very diversified set of methodology. We are not concentrated on any one specific factor, and that's what helps us. So we have about 70% focus on technicals, about 30% on fundamentals, and we do have a macroeconomic overlay on top of that, which actually helps us construct these portfolios in a very robust way.
Yeah, that's mind-blowing, sir. It is also shown in your product's impressive performance, sir. So, what do you think about Sebi's recent action against global quant firms like Jane Street, sir? Do you believe this could influence the sentiment or participation of other foreign or even domestic players in the quantitative investing space?
I really don't believe this is maybe it'll impact maybe in short term, but over long run it is not really going to impact at all. I think Sebi has done. It looks like looking at what they were doing. It looks like the right step, and usually these kind of investigations lasts actually years. But in this case, it was a very swift response from Sebi, and I think it more than anything it gives participants a lot of positive indication that Sebi is really watching all the participants in the market. Um, is not going to let anyone game the system, which in this case it seems like a clear case of gaming the system. So I think it gives a lot of confidence uh, to all the kind of market participants. Maybe this kind of an event could have a small impact over short run, but over medium to long term, frankly, I think these kind of events are actually net positive for the whole ecosystem.
Understood, sir. So, what's your view on Trump's renewed tariff stance, sir? How do you see it impacting global risk sentiment and capital flows?
Yeah, so Arvind, see, we are a quant firm. So what happens is our expertise, our capability is looking at data and driving it, right? So one of the things that we really follow is we don't really try to predict. Rather, our algorithms, our methodology is meant to adapt to the changing market conditions. Because, and I think this is a very good example. Normally, these kind of things are really hard to predict, and everyone knows in case of Trump how erratic his behavior is, right? So one day he says something, another day he'll do something altogether different. So it's very hard to predict, not only for in this case Trump, but these kind of events are very hard to predict. So we don't really waste our time in predicting these kind of events. And if you look at all the good investors, really, they are not very good at predicting, and they know that you really can't become good at predicting future. It's a very hard or almost impossible thing to do. So rather, what you should spend your time is on adapting. So once the news is out, once the data is out, how do you adapt to the new market conditions? So there's a lot of data, a lot of news. When it is out, you try to make sense out of it, how it will impact different stocks, different sectors, and parts of the economy, and then position your portfolio accordingly. So I think even in this case, what we try to do, not only in this case, but overall also what we try to do is we try to adapt rather than we try to predict.
Yeah. So proactively adapting is the key takeaway from this. Okay. So how does your quant model balance between alpha generation and low volatility, sir? Is there a trade-off between risk reduction and alpha generation?
No, I think that definitely there is always a trade-off. These are two sides of the coin, and there's always a trade-off between alpha and risk. But in our case, we do not really think in terms of alpha and risk separately, because what we try to do is in quant investing, it's a mathematical puzzle for us because we have lots of data. It's always a mathematical puzzle and you are trying to optimize on something, right? So multiple things you can do actually. One of the things that you can do in quant models is maybe to maximize your returns. So in that case, you're just focusing on alpha, right? Or the other thing is you just focus on the risk. So you try to create a portfolio which is the least volatile portfolios, right? So you're trying to minimize risk in that. What we try to focus on is on optimizing or maximizing the information ratio. So what information ratio does is, and recently, couple of months back, Sebi has mandated all the mutual funds also to report their information ratios. So let me just quickly explain what information ratio is. Information ratio gives you how consistently you are able to beat your benchmark index. So there is a separate metric by the name of Sharp. In Sharp ratio, it is just how consistently you are able to produce returns. So it is your returns divided by risk, right? Whereas in information ratio, it is your returns divided by the volatility of excess profits that you are able to generate. So actually, it is a very good measure to 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 see how well an active fund manager is able to beat its benchmark index and how consistently it's able to do that. So in our methodology, we are trying to optimize the information ratio, and the way it is done is obviously at the end of the day, alpha, what happens in alpha, it's all about factors, how actively how actively or efficiently you are able to assign, allocate capital to the multiple factors, right? So some of the most popular factors are momentum, growth, quality, low vol. These are the factors. Now, what happens is in rising market, few factors work well, whereas in falling markets, other factors that are likely to work well. So, how efficiently you are able to allocate weights is something that really helps you in generating alpha. And on the other side, the risk side, uh, you don't be fixated only on few factors. So in our methodology, we are tracking almost 130 factors across all the sectors and stocks, using which we are able to construct our portfolios. So it is a very, very diversified set of factors that we use. Additionally, what we are doing for minimizing risk is our portfolios, you'll be surprised that they have almost 80 to 100 stocks at any point of time. So with these 80 to 100 stocks, we have been able to produce huge alpha, and our information ratio, if you measure, it's amongst the best in the industry, right? Even with this kind of diversified portfolio. And why we have come out with such a diversified portfolio is, see, wealth can only be generated over long run. In short run, if you try and maximize your returns and invest in a very concentrated portfolio, uh, so in the rising markets, obviously everyone will be happy, but in the falling markets, investors will be the first to run away. We really didn't want to construct that kind of portfolio. We wanted to construct a portfolio in which investors are able to stay invested for long term. And that's why we have focused a lot on mitigating these risk factors by constructing a really diversified set of portfolio.
Wow, it's very informative, sir. We got a short quantitative investment session from you. So, what are the key risk thresholds or limits that trigger review or rebalancing in your portfolio, sir?
So in that case, what we actually focus is on the cone of confidence. That is one thing that we are. So into this cone of confidence, what happens is what we have done is historically we have taken almost 15 years of data and see how well our strategies have done. It's all not only how well, but how badly we have done in the past 15 years, given we are following this specific methodology. So what this specific graph tells you is, if you see the orange line, that tells you what is the worst case possibility in our backtesting results. So if you see the 12-month returns, the worst case is close to 0%, right? And if you see 24-month, it is maybe, I can't really make out, but maybe it's 12% or somewhere between 12 to 15%, let's say. So this is the worst case returns I know that can be in my methodology, at least looking at the historical returns. Now, if you look at the top line, which gives you the best case scenario, that over 12 months, the best case scenario has been about 50% returns. Now, these are, mind you, these are not returns, but these are active returns. on top of benchmark how much you have been able to generate. Now, over 12 months, the best case scenario has been about 50% returns, right? And the green line is the average one or the expected one. Now, what we do is we try and track what has been the recent performance on this chart. Ideally, if your recent performance is good, you will actually be above that dark green line. If your recent performance is not good or below expectations, then you'll be below that green line. So you'll be somewhere between the highest and the lowest lines. But if actually you are falling below that orange line, that is actually a cause of concern. And that is the time when we go back to the drawing board, look at our assumptions, look at the data quality, look at all the things that we have considered or assumed while constructing our methodology to see if we have missed out on anything. So that is the time when we actually go back to the drawing board and really look at, reassess all the things that we have taken care of in our back testing. So overall, most of the times, see, over longer run, our methodology has worked well. Past 1 year has been slightly a blip because past 1 year we have slightly underperformed, but overall we are very happy because as any active strategy there is, over 5-6 years, there'll be 1 or 2 years you'll be doing badly, whereas there'll be 3 to 4 years where you'll do really good. And that's how it has been in the live markets also for the past 6 or 7 years that we have been operational.
Yeah, got it, sir. So, how quickly can your system adjust positions or reduce exposure in the event of a sharp market dislocation, sir?
Yeah. So what happens is in kind of knee-jerk reactions, you always tend to take something of the wrong decision. Now, our approach is very, very systematic. It's very rule-based. If the data tells us that is we always follow the data. We'll never really try to second guess what the system is telling us, right? So knee-jerk reactions, we definitely never take those kind of decisions. What our methodology has told us, and this is after exhaustive testing, that one of the best ways that you can produce results is when you reassess and rebalance your portfolios on a monthly basis. That gives you the very right sweet spot of not having too much of transactions also, and a fairly long time frame, 1 month, a fairly long time in which your data would have changed drastically. So we really don't do any rebalancing during the month. It's only at the end of the month that we look at the data, we look at all the indicators, and then go ahead and rebalance our strategies. Now, really, see, in this case, what also investors should realize is our capability, our strength is in looking at data and then constructing the portfolio, right? Our capability is not really in discretionary style of trading where we try to, from our experience or from our analysis as humans, we try to take a call on a sector or a stock. That's not what our expertise is. So any fund that you are investing in, ideally, I think it will be a huge red flag if your fund manager who has a strength in one area tries to do something out of his area of expertise or his cone of confidence, right? So that is not something that we try to do manually. We'll never try to second guess our algorithms and do something which is against what the data is telling us.
Fine, sir. So we have already started getting audience question. Dear participants, you can post your questions in the Q&A box. So since revamp your long alpha strategy has given 30% CAGR, so what are the primary factors do you think has attributed to this tremendous performance, sir?
So Arvind, in India, although I've told you the kind of factors that we look at, and one of the really our strength has been that the huge diversification of factors that we are using, which has helped us generate these kind of returns. What you mentioned about 30% CAGR. But in India, the most prevalent factors that are there is momentum and size, right? So these are the two factors that really help us generate very high alpha. But at the same time, I think our strength is not really in momentum and size. Our strength is in that we have these diversified set of factors, and we are able to rotate these factors based on the prevailing market regimes. I think that's where our strength is, because every month what we try to do, and this is again done purely systematically by algorithms, that we try to predict which specific market regime we are in. And based on that specific market regime, I'm not going to use all 130 alphas. What I'm going to do is I'm going to give weight only to few factors that are most likely to work in the current market regime. The edge in our portfolios is exactly that we are able to allocate weights to these factors very efficiently across different market regimes. Although having said that, the two most prevalent factors that have done really well for us, and that seems to be the case in India with all the quant strategies, is momentum and size. Those are the two that really work well for us.
So, how do you define quality in your factors of investment, sir? Is it more earnings consistency, balance sheet strength, or capital efficiency ratios like return on equity, return on invested capital?
Yeah,
So,
see,
how?
there are many, exactly, there are many such factors. It's a mix of all of these quality, and all of these are obviously can be quantitatively defined. So we definitely do look at asset turnover, cash flow from operations, return on equity, on capital employed. These are the primary ones that we are using in our quality factor.
How do your model resolve conflicts when different factors send contradictory signals, sir? For example, a high momentum stock may have weak quality or high leverage.
Yeah.
So,
So I think that's where, Arvind, our the strength of multi-factor methodology is there, right? Because I just talked about regime, market regime, right? So based on regime, we are able to determine which specific factors are most likely to work and how do I allocate weights so as to get the best information ratio that I just spoke about, which is the best, most robust returns, most stable and robust returns, right? So that is the strength of the multi-factor methodology, that we are able to determine specifically when to allocate weight to which specific factor. And that's why it's a very systematic, very clean approach. You actually are never confused about what the data is telling you. It's a very clean approach you are able to use. And as I said, it is a combination of multiple factors that we are able to take into account given the market regime that we are currently in. And we definitely never look at individual factors. We always look at the factors that are most likely to work in current market regime in and have a 360 degree view using that.
yeah, got it, sir. So, sir, ST's I alpha has never posted a negative monthly return since inception, which is for 15 years. So, what are the key drivers behind such consistent performance? Is it more due to risk controls or else factor diversification or strategy design, sir?
So I just like to tell our viewers, so till now what we were talking about is the strategy or the PMS, which is known as by the name of long alpha. That is equity only, long only strategy. Whereas now this Arvind just referred to our strategy, which has been running for almost 17 years now, by the name of I alpha. Now this is a market neutral strategy in which we are doing index arbitrage, which is pure index arbitrage. It is meant for very conservative investors, right? So any investor who typically is investing a part of his money in either debt funds or FD, that those are the kind of investors who typically invest in this. And the strategy is actually very straightforward, Arvind. It is known as index arbitrage. So in that, what happens is, let's say you have Nifty versus its 50 components, right? So what you can do is, and we do this trade in futures, where we are tracking Nifty, where Nifty futures are getting traded, versus a synthetic Nifty future. So we construct a synthetic Nifty future using all the components, right? So I might as well, if I want to go long, I can go long and buy Nifty futures, or I can buy those 50 Nifty 50 futures in the weightage that is there in the Nifty 50 index, right? Now I am tracking these two prices, synthetic Nifty versus Nifty. And whenever there is a deviation, which happens multiple times in a day, uh, so let's say Nifty 50 is undervalued and synthetic Nifty is overvalued. I'll buy Nifty 50 and short the overvalued Nifty, synthetic Nifty. And this is a sure short profit because when the futures expire at the end of the month, last Thursday of every month, futures expire, and that is the time then this trade is sure short, it will converge to zero. Irrespective of whether the markets go up or down, this is a spread trade which will actually converge to zero, right? So that's why we have been able to deliver the consistent returns that for the past 17 years, not even a single losing month we have had in this specific portfolio.
Yeah, that's a
Again,
very
this is
interesting.
being done under PMS strategy.
Okay, that's a very interesting proposition, sir. Zero negative monthly return for 17 years itself would be convincing for a lot of investors. So,
Yeah,
due to this high level of consistency in I alpha, we would like to know about the I alpha's three-tier risk management system, sir.
we are tracking risk on three levels. One is at the fund level. So in fund level, we have the inbuilt thresholds of risk limits in the algorithm. And there's no explicit leverage, but we may take implicit leverage, which is anyways there in the futures. And we get that implicit leverage from the exchange because we are fully hedged all the time. There's no point of time in the day when we are unhedged. It's always fully hedged. The second level of risk management is at the strategy level, where there is explicit market exposure budget by strategy and also explicit daily stop losses for each strategy. And then you have at the operational level. So on the operational level, we ensure that daily position limits and fund reconciliation are followed. And also we ensure that exception monitoring and logging to the management team is done on a daily basis, and we report it on intraday and end of day market exposure and at the P&L level. So all of these things are being followed, and this is being done. See, this is such a well-oiled system that it almost never breaks down. We have been running this system for 17 years. The key edge here is in our infrastructure, really, because our infrastructure can really trade at microseconds or even nanosecond frequency. So the trade in itself is very, very simple, but the faster you are able to execute, the better it will be for you, right? So that's the edge here we have in our I alpha PMS.
Perfect, sir. So, how does the low correlation between long alpha and high alpha helps investor reduce the risk, sir?
So, see, I alpha has zero correlation with long alpha, and that's the beauty of these two products. So, because of this zero correlation, a lot of investors actually do end up investing in both of these products because long alpha acts like an accelerator, right? You are able to grow your money at a very fast pace. I alpha acts like brakes, so it keeps your overall system and portfolio safe and sound even during bad times. So if you look, see what we have created is a lot of investors do invest in around 60-40 proportion. So 60% in long alpha, which is equities, 40% in the arbitrage fund, I alpha. So if you look at our performance since May 2019, and we have actually compared, this is actually not a fair comparison because here we are comparing our 60-40 portfolio to BSE 500 index. Now BSE 500 is a 100% equity portfolio, whereas our 60-40 portfolio is, as you can see, has 40% debt. So it's really not a fair comparison. And you can see the risk that we are taking. The standard deviation, which is a measure of risk in any portfolio, is 11% in 60-40 portfolio versus 18% in BSE 500. So there's huge amount of risk, and that clearly is displayed in the maximum drawdown also, that this specific portfolio had a drawdown of only 14%, whereas BSE 500 had a drawdown of almost 29%. So roughly half the risk is what you are taking. Also, the risk to return or return to risk ratio rather is double that of BSE 500. And it is clearly being reflected in the returns that even though you are taking very low risk in our 60/40 portfolio, still you have a very healthy rate of return at 23% compared to that of 17% in BSE 500, right? So a very unique case. You really don't find these kind of products anywhere, that you're able to reduce your risk drastically, and at the same time you're able to beat the benchmark index by a fairly wide margin. Now 6% is a fairly wide margin over last 5 years. So this is something that we are really proud of. And so in this, I have clearly shown what has happened in the last 1 year. As I was telling you, we have had last 1 year some bit of underperformance. So in long alpha in financial year 25, we produced 2%, whereas BSC 500 gave 6%. So there's some bit of underperformance, but because these two are uncorrelated products, I alpha produced very healthy 15% returns, right? So therefore, Estee's 60/40 portfolio were able to produce 7%. Again, this we were able to beat in a very bad year, not only for equities, but also for us, where our strategy didn't perform as expected. We were still able to beat BSC 500 uh, in a bad year as well. And obviously in the good years where both these strategies perform, we get a very healthy alpha with hugely reduced risk profile in our portfolio.
Yeah, fantastic, sir. Your offerings are quite unique, sir. So finally, is quant investing just a black box where machines make all the decisions with no human control, or it's the other way around, sir?
No, I think, Arvind, rather than being a black box, I think it's a big myth actually that quant strategies are kind of a black box in which you really can't see what is going on inside. On the contrary, it's actually a glass box where you can actually see exactly what is happening with the strategy, why it is able to produce returns, and why it is maybe struggling, right? So, because it is although it is rule based, it is the all the trading is being done by machine, but that machine and all the rules are actually designed by humans, which is backed by rigorous data and research. And we are very transparent in how these models are being built, how these models are being tested, how it's monitored. Even execution is very systematic in nature. And there's a huge edge because I just spoke about our infrastructure. There's a huge edge in our execution as well. So every single piece of performance, we are able to really attribute it to a specific sector, a specific stock, or even specific factor. So we're very clear, very transparent. We're able to determine what is happening, why it is happening. So it is actually a glass box rather than being a black box with a very clear logic. And all of this happens without emotions. So that is, I think, a big advantage of quant investing.
Understood, sir. I think the prevailing myth around quant products is broken now. So if you're okay, we can go ahead with your audience question, sir.
Yeah, definitely, Arvind. I'll be happy to take them.
Yes, sir. Ankit Doshi is asking, as you rightly said, some factors work when markets go up, while others when markets go down. Have you tried in any of your experience to time these factors itself?
See, that is essentially what we are doing, but we look at market regimes when we are trying to time the market, time the factors. So this timing is not necessarily being done in isolation. It is being done by looking at markets, where markets are currently placed and what is likely to work in the current market. So essentially that is what we are doing in our methodology. It is factor timing, and we are able to time it very well because we are able to study and determine the market regimes well.
Desai is asking, which data provider do you use to perform backtesting and run analytics on your portfolios? He is asking about
So
the softwares.
yeah, see, software, analytics software, everything is built in-house. We use multiple data vendors. One of them is Bloomberg, another is CMIE. and there are few more, but primarily these are the two that we use. But all the software after that, we take in data. After that, everything, all the analysis is being done in-house only.
So Vaibhav Mehta is asking a question. How do you see Estee's quant product against the other products in the market? So he's asking how different is Quant's offering.
I think two things. I will talk about execution first. So what happens in quant is there's uh, lot of execution being taken place. A lot of churn is there, and that works in your advantage because if a strategy, if a stock is not really moving, you're very quick to remove it from your portfolio as well. So there's fair bit of churn uh, in quant portfolios, right? The edge that we have in ST, which I believe I don't know of any other firm that has that kind of edge, because we are very good in execution. We have our high frequency execution systems in which we are able to analyze the markets and execute very, very efficiently. So that in itself gives us a huge edge as compared to any other quant firm who is able to maybe design the portfolios but not execute properly. So a big edge is in execution. And second edge is in our huge focus on the multi-factor methodology and research, right? Because we have now over 130 factors, and these factors, mind you, are not only driven from our research in India, but also in US, Brazil, Hong Kong, Korea, China. So we do our research in these multiple countries, because of which we are able to really create very robust portfolios, because there are a lot of learnings that happen in one country. But if you are focusing on multiple geographies, then you will be able to learn at a faster pace. You'll be able to see what has worked in US for the past 50, 60 years, or what has working well in an emerging economy like Brazil. So that kind of learning is, we are able to utilize all of that learning in India to create a very robust portfolio. So I think our focus on research, on this multi-factor methodology across geographies is another area which makes our portfolio stand apart from any other quant manager. And I think, Arvind, the third part I would really like to highlight that is, we don't deviate from uh, where our uh, area of expertise is in. So our area of expertise is in quant. Now, there are a few quant managers who try to take a call on the market, or maybe they try to hedge using hedge. So all of that is outside their area of expertise. So at times they can succeed in doing that, or at times they'll fail also. But net, see, these things are not going to add a lot because that is outside their area of expertise. So I think one thing that we are really proud of is that we really don't work outside our area of expertise. And most of the investors really love us because of that we know where our strengths are, where our weaknesses are, and we just stick to our area of strength.
Yeah, that's a key takeaway, sir. Working on our area of expertise. So Navneet and Aurora is asking similar question. I will club it into one. So what has been the highest drawdown in your portfolios, and do you have any stop loss in your algorithm for capital preservation?
So yeah, so this is something that we have again tested exhaustively to have stop losses, stock specific stop loss, and also on the other side have profit targets. So if a stock has run up too fast, too soon, then maybe you should book profits. But see, we haven't been able to find any edge really in those kind of either putting stock specific stop losses or profit targets. Really, in short term, once in a while it might help, but then there are other cases where it will go against you also, these kind of decisions. So this is again, we have tested this exhaustively and found out that what we are following, which is rebalancing once a month at set frequency without having stop losses or profit targets, stock specific, has really worked in favor. So that is a better strategy than what is being suggested right now.
Got it, sir. So Abhishek is saying, good evening, Vivek. First of all, thanks for taking out the time to enrich us with your experience. So could you explain what is your annual turnover ratio?
So our annual turnover would be in the range of 300 to 400% of our AUM. That is. So the average holding period would be, say, about 3 to 4 months. That is the average. Obviously, there are many stocks which we exit within a month, and then there are many stocks which we hold for almost a year.
So Vaibhav was asking another question. Is quant style of investing successful under bear market conditions or slow growth conditions?
Yeah, definitely. See, what we have seen, uh, you might maybe call it a failure. I don't really know what has happened, at least in our experience, that whenever that bear market has come, we have underperformed. But in the run up, and it's again reaching those highs, we are able to recover our losses faster. That is, I'm not talking about quant in general, but I'm talking about only our strategy, how it has performed based on the results that we have seen either in live markets or backtest. So obviously, in the good markets, we are able to produce huge alpha, right? That alpha is of the order of 20 or even 30%. In bear markets, we lose as much, maybe slightly more, slightly less, but around those same lines. But the good thing is our recovery almost always has been very sharp. We have been able to recover those losses at a much faster pace than the benchmark index. And that is the edge in bear markets, that maybe we lose roundabout similar to that of benchmark, but at least even if your recovery is faster, that is a huge advantage. So that is this is according to the data that I have seen in our backtest and live markets.
Yeah, understood, sir. So Rahul is asking a question. What are your thoughts about the new investment avenue, specialized investment fund? How will this affect existing investment options?
See, it's still yet to be seen. For us as a firm, we have just applied for a mutual fund license a couple of months back. So we will be coming out with these strategies in mutual fund format as well, right? But talking about SIF, I think for our the our kind of firm, the kind of trading, because we do a lot of trading also in our proprietary um, framework, and we do a lot of these kind of long short strategies, right? And we believe we've been able to do it for past 15 years. I think we are very well positioned for offering these kind of strategies. So overall, what I'm trying to say is there are few firms who have huge advantage in that space who have been doing, whereas many firms, many of these AMCs who are into mutual fund, who have offered regular mutual funds, now who will be trying to get into this space, for them specifically, what I would be uh, slightly cautious and see the actual returns performance over at least 1 to 2 years. Only then get into that space. But it's an exciting area really, because there'll be huge differentiated offerings from in this area of SIF. So I'm really excited about this personally also, what we can do in Estee and overall in the investing ecosystem also. I think there'll be really good differentiated strategies that will come out of it. But investors shouldn't really be too eager to get into it. They should just let these AMCs come out with it, show the performance at least for a few quarters, and only then go and invest.
Yeah. So there is a question from Doshi. When the market regime shifts from uptrend to downtrend back in October 2024, which factors in your portfolio are your best bet?
So, see, this is generic. Exactly what happened in October 2024, I don't have the data right now in front of me. But uh, what I've seen in my experience, normally growth, size, and momentum works really well in rising markets, whereas in falling markets, quality, low vol, and value are the ones that work very well in falling markets. So that is the broad trend. Now, it totally depends on the kind of system and how sensitive your systems are. Now, I'm getting into a bit more technicals here, right? But it totally depends on how sensitive your systems are to these regime shifts. You can make your systems very, very sensitive to this, so that regime shift would happen very fast, uh, and you'll be able to latch on to that trend at a fast pace. But if it is just a blip and the trend actually continues, then you will actually would have taken a wrong decision. And in that case, a slightly less sensitive system would help. So I know it's a bit, the things that I'm explaining are a bit technical, but that's how I look at it. That's how I would want to explain this.
Yeah. So Rahul Shah is asking, can you please elaborate on momentum and size factors specifically in
Sorry.
your portfolio? Rahul Shah is asking, can you please elaborate on momentum and size factors in your portfolio?
Yeah. So momentum, and this is not only about our portfolios in general. What momentum states is that any stock, this has been seen across geographies, any stock that is in momentum, that is rising very fast, will continue to rise over the next short term also. So let's say, for example, you do a very simple thing, that you take all the BSE 500 stocks, top 500 stocks, you rank them in the order of returns for last 6 months. So the stocks which have given the highest returns would be at the top. You select the top 20 stocks and make a portfolio out of it. Now, this simple strategy works very well. So over the next 1 month, the top 20 stocks that you have selected based on past 6 months returns would actually tend to produce much better returns than overall all 500 stocks. So you are able to beat the market. Now, this is a very simple momentum strategy. Now you can apply a lot of mathematics on top of it, right? What you can do is you maybe can study momentum with volatility. So you account for volatility. So you see, you obviously need that momentum, but which is the most consistent stock in that? That also you see. Or you can do a lot of things. One of the things that momentum traders do is you ignore the past 1 month data, right? So you have taken past 6 month data, but the most recent 1 month you ignore and only take those 5 months, and then you use that in momentum. So that is momentum. Basically, every manager would have a different way of constructing these momentum portfolios, but essentially that is what it is. Ki last some time frame may you look at the returns and you pick the stocks which have given good returns in past 3 months or 6 months and hold it for the next 1 month. So that is momentum factor. Second factor is size. So size factor, what it states is that the smaller the size of the company is, there is some alpha in that also. So if you apply a momentum factor, let's say on a large cap versus a small cap tends to work better than large caps, because obviously you are taking some risk in selecting those smaller cap stocks, and you expect some sort of compensation from the market, right? So these are the two factors that we spoke about earlier: momentum and size.
Yeah. So there are other questions are based on how to invest and how to do SWP. Those questions we will share it to you, sir, so that your team can
Yeah,
answer.
definitely. I'm happy to take those questions.
Yes, sir. I think we are done for the session, sir. The remaining questions we will share it with your team.
Okay.
So yes, sir. Thank you so much, sir, for your presence in our show. It was absolutely great.
Thank
Thank
you,
you all.
Arvind. Thank you, everyone. Thanks a lot.